Let me show you the exact 5 chart settings that helped me spot NVIDIA before its 180% run. Imagine a pilot's cockpit. There are millions of gauges, switches, and screens, but the fact is that the pilot doesn't use all of them to safely fly the plane. Trading is exactly the same. While most traders clutter their charts with 20 plus indicators, trying to predict every move, these 5 essential settings are all you need. Just like a pilot's altimeter shows their exact height, these settings will give you precise levels for entering trades, and like the navigation system of a plane showing the plane's direction, one of these indicators tells you exactly when a stock is ready to fly higher. In this video, I'll show you the perfect time combination that most traders miss, the golden moving average setup that signals massive moves in the market, and the one secret indicator that tells you if a stock is ready to explode higher. Plus, I'll share the complete trading checklist in my free Profit Punch newsletter that you can sign up in the link in the description. But first, let me show you why these settings are the only ones that you will ever need. In 2022, these settings would have helped you catch AMR, which was a call stock. It did 200% in 6 months. NVIDIA in 2024, subscribers to the newsletter caught this move. It did 190% in 5 months. And later in the video, I will show you these potential trades that you could have made on this gold stock. SMCI also could have been found. It did 300% in 3 months with these indicators. The first thing is stop looking at just one time frame. I use a daily time frame for entries. The primary or the daily chart pinpoints your perfect entry points. This is why you'll know when to get into the stock. And then you also want to have a secondary chart, which is a bigger time frame. I use a weekly time frame for the bigger picture, and this shows you the massive trends that can deliver these 100% gains. And of course, this works for any time frames. If you're a day trader and you trade on a 1-minute chart, then you want to be looking at the 5-minute chart at all times as well. If you work on a weekly chart and you're a long-term investor, then you want to be looking at the monthly chart, which is 5 weeks or 4 weeks. And after that, you want to make sure that you have the perfect moving average setup. You want to make sure that on your daily chart or your primary time frame, you want to have the 20-day exponential moving average. This shows a short-term trend. You want to have the 50-day simple moving average. This is best for people who follow the daily chart. And on the weekly chart, you want to have your 10-week simple moving average. Since 1 week is equal to 5 days, this is very equivalent to the 50-day simple moving average. In the same way, you want to have the 30-week simple moving average, which shows major trends. And this is equivalent to 30 times 5, which is 150 simple day moving average. Every time stocks bounce off their 50-day and 150-day simple moving averages during the weekly uptrend, these are normally good buys. Here we have a chart of NVIDIA in 2024. So it broke out here in about January and it did a very big ride up. NVIDIA first went up 90%, which you could have profited from. Then it corrected. The dark black line is a 50-day simple moving average, and then the light line is a 20-day exponential moving average. On the weekly chart, you want to be having the 30-week moving average, and then you want to be having the 10-week moving average. So when NVIDIA corrected, it only corrected to the 50-day simple moving average. You could have seen it here on the weekly chart as well. And then once it does that, it bounces off that and then goes for another move. And this move was about another 90%, which was another profitable move. It comes and does it again here. It comes and bounces off the 30-week moving average, which we can see here. Whenever the 30-week is sloping up, that means that the major trend is still strong for the stock, although it might be weak on the daily chart. In this particular example, this was not exactly an entry point, but I'm trying to show you how NVIDIA still went up 40% after it bounced. The second example is NGD, and here I show you how you could have profited by swing trading from this stock. As I already showed you, we have our weekly chart here. You want to see the stock always above the 50-day simple moving average or the 10-week. That is normally the very strong trend. Most strong stocks will always stay above the 50-day simple moving average. So here was our first entry. We wait for it to bounce off the simple day moving average. There's something called a closing price reversal, which I'll discuss in my other videos. This is something you want to wait for. And after it bounces off like that, it forms something also called a cheat here. something which I show in my other videos, and as soon as it jumps up there, it is a buy. Your risk is about 5%, and you had the potential to make 21% on the trade. But of course, as traders, we never ever get the maximum profit. Ideally, we were only going to get about 3 risks from here. So I said 3-hour profit. Next trade, it comes back down. Whenever it comes to the 50-day simple moving average, you want to make sure that it is consolidating for at least 4 weeks. I like to see at least 15 bars on the daily chart, which goes to around 3 to 4 weeks, which helps me know that the consolidation is done. So here, I can always count here. I want to see at least 3 to 4 bars. 1, 2, 3, 4. We see it bouncing again. You could have done a second trade here. Your risk is about 6% this time. I'll have another video where I explain what type of risks you should take. That is another skill that traders should learn, the risks that you should go in. And then you could have made about 3 times your money. So if you risk $1,000, you're making $3,000. Of course, as traders, we never know the exact peak, so maybe we shall get around 3-hour profit. So this second trade was successful as well. We go into the third trade. It comes back, bounces off the 50-day simple moving average. We want to see at least 15 bars. We calculate from here. We can see that this one took 14 bars, which is very close to 15. So I still took the trade here because gold was acting very strong. This one went up 5 times, but ideally you're only going to get about 4 risks of your money back. With a 5% risk, you're likely to make about 20%. So we can see all of these moves were just about 20% moves. And then here you're getting 4 risks back. So currently you have 3 plus 3 plus 4, right? So that is 6 plus 4, you have 10 risks. It came and bounced off the 50-day simple moving average. This is a trade which I took and recommended to our subscribers as well. But this one did not reach our goal. So it instead turned into a loss. So there is a 1-hour loss. So for all the potential trades you could have made here, waiting for it to bounce off the 50-day simple moving average, there were 4 trades. You have a 10-hour profit and a 1-hour loss. If each hour was $1,000, you could have made a total of $9,000 in profits. As swing traders, we never know which trade is likely to work out. We just want to be choosing the best options out there. The second thing that you want to have on your chart is an earnings table. On that earnings table, you want to be seeing the earnings per share, year-over-year growth, and great stocks will have 30% year-over-year growth for the last 4 quarters. A stock which has 100% growth average for the last 4 quarters is a super growth stock and is something that you want to keep an eye on. You want to be looking at revenue growth in that earnings table as well. Great companies will have 15% year-over-year growth for the last 4 quarters. I would say even anything above 50% in year-over-year growth in revenue is super growth stock, and you need to keep an eye on that stock. You also want to be looking at the return on equity. Great companies have a return on equity which is about 17%. Return on equity formula shows how successful the company is using the shareholders' equity. The formula is net income divided by shareholders' equity. Not every profitable company is going to be moving up in price, but when a company is showing great technical indicators on the chart and it has great earnings, the company is going to blow up, as I'm going to show you in the examples. This year, there is a company called AppFolio. If we look at the weekly chart, I showed you that you must have your earnings table. Here we can see the earnings per share is above 100% for the last 4 quarters. And ideally, you want to see this earnings per share accelerating. So what does that mean? Not only is it growing a lot, it's also increasing its rate of growth. So if it did 100%, then you want to see it do 200% next time, then 300% next time. That means it is accelerating. Revenue growth is absurd for this company. We want to see something above 15% for the last 4 quarters. This one has 40% for the last 4 quarters. Return on equity was looking good. We put this on the weekly chart as well. And we can see that this company, after it formed these bases, this is a trick that you must also learn. You must learn how to profit from these bases. So it formed 2 big bases this year. The first one, it jumped out and made a 90% move. The second one, which was recommended to our subscribers in the newsletter, also jumped out and did a 95% move. These are very great moves which can move your portfolio. The next stock is ANF. Now, Abercrombie, I don't even know how to say it. Abercrombie and Finch. This is the weekly chart. The earnings are through the roof. The return on equity is superior, as we have already said. Now we are adding all our indicators onto the charts. For simplicity, I didn't add the moving averages. Sometimes I don't want to see them so that it don't block my view, but ideally you should have them. So we see that after it formed a very nice base here, these light green bars that you see is a setting that I put in my chart to show me which weeks have very high volume. So whenever the volume is above 50% over the 50 SMA of the volume, then it's going to just label this bar as green. These yellow bars that you see in my chart, those are weeks that have tight price action, as I'll explain later. So after this company formed this very nice base, it did 777%. That means the money multiplied times 8. If you put in 10,000 into this company in 2023 right now, you would have $80,000. And that's how powerful these chart patterns can be. The next thing that you want to do is understand relative strength. You want to always find stocks that are very strong compared to how the market is moving. There are two types of relative strength, and people do not seem to distinguish this. There's relative strength relative to a market, because the market is measured by the indices. There is a NASDAQ, there is a SPX, there is a DJI, the Dow Jones Index. There's also the Russell 2000, but most times people use the Standard & Poor's 500, S&P 500. There's also relative strength, which measures the strength based on how this stock has been doing in the past. I like to use the relative strength that is just based on the individual stock. This is because some markets are not correlated. Some stocks like gold stocks have poor earnings, but since the price of gold is going up, the stock is likely to be very strong. Now, even if there is a bear market and the economy is collapsing, but gold as a commodity is going up, then gold stocks are going to go up regardless. As I told you, some stocks are not correlated to the market itself. 2022 was a bear market, but AMR was making very huge profits while the rest of the stock market was collapsing. That is because the price of coal was increasing, and this stock is a coal stock. That is something which you must understand. Now, for the relative strength, which is based on the stock itself, we use the closing prices. So the latest price has the strongest strength, and then the price, which is several days ago, has weaker strength. This is a formula. I always urge people to always know the formula of these indicators so that they understand what the indicator's limitations and strengths are. So for this particular indicator, anything which is above 60 means that the stock is very strong, and I always keep an eye on those stocks. I'm also looking for stocks which just have above 20 as a result of this formula. If a stock has below 20, then I just don't even look at it. It's normally a very weak stock that is not moving up. The golden rule is try to avoid stocks which have below 20. So this is something which I do have on my daily chart, and I can already see the relative strength of this stock. As we can see here in CRS had very strong relative strength. So now this is a chart which has all our indicators where like pilots, and we can see how we should enter the stock. Return on equity is not the best, but sometimes when a stock is acting very strong, I tend to ignore the fundamentals, and sometimes fundamentals alone do not drive the company. So this time the stock was strong. Whenever it has an IBD-RS of over 60, I just even ignore the fundamentals. The earnings per share was going so good. They only had one bad quarter, but a lot of their growth was in the triple digits, which is amazing. The revenue growth was all over the place, but the stock was acting strong. So here I show you the bounces that it did on the simple day moving averages. So let's go into the chart itself. Here we see two potential trades that we could have taken in CRS. So here we have a strong relative strength. Here we have our weekly chart with our moving averages. So we always wait for a pullback to the 50-day simple moving average on a very strong stock, which is what we can see here. This CRS stock had several entries. The first is this major breakout over here. So if we draw a line here on the weekly chart, the stock did break out on huge volume. This is a very good sign. So that is the first time we can enter the stock. After it does that, we're waiting for it to pull back to the 50-day simple moving average and make sure that it pulls back very well. So it did pull back, and that was a very good buy. So here you could have made 8 times your money back. Of course, as a trader, you're not going to be making the exact full profit. Maybe you'll just make 5 times your money back. But the fact is that if you put in $1,000, you could have made about $7,000 on this trade. With a 5% risk, the stock moved up 40%. It then came back, consolidated. As I told you, we always want to see at least 4 weeks, 3 to 4 weeks of consolidation. So we can see that here, 1, 2, 3, 4, 5, 6, pulls back to the 50-day simple day moving average. We have our indicators there, and then pulls back we have a good entry here. You have to wait for something called a closing price reversal, which I'll teach in the next video. And then it does have a 20% move, which could have profited from 3 times your money back. So if you have a 5% risk $1,000, you make $3,000 on this trade. It does the same thing. It came and pulled back here. I did buy. It moved, it went in, and then it stopped me out because, as you can see, the move, it bounced off the 50-day simple moving average, went up, and then came back and stopped me out. So this was a loss on my part. But that is after you could have had 2 successful trades. In the stock market, we never know where it's going. We need stops to protect ourselves in case something goes wrong. But as long as we always make high quality plays in the long run, you're always going to be making money. So for the relative strength that is relative to the market, which is the second type of relative strength, I normally use the S&P 500. So I want to see how strong is the stock relative to the S&P 500. So for this one, we want to see it having 2 things. First of all, you want to see this value above 0. When this value is above 0, that means that the stock is moving stronger than the S&P 500. We also want to see this relative strength sloping up. So normally we add a moving average to that so that we can understand that, hey, this thing is going up. So we want to see it above that moving average. So here I use a stock called Pi. It did a 40% move, which everybody could have profited from. We can see the moving averages in the weekly chart. Sloping up, it comes and bounces off those moving averages. These are very good buys. There are other many things in this chart, which I'm not going to be teaching in this video because that's out of the scope of this video. There's something called an undercut and rally. There's something called a chit that forms here. And then it has something called a buyable gap up. So when the stock gaps up like this is a very good time to enter. And also when we see the relative strength compared to the market, we put a 10-day simple moving average on that indicator. And then I see that, hey, this stock is always above that indicator. So when it jumped up here, it was above that indicator. For this stock, the earnings were kind of good and bad, so they were confusing. But the fact was that the relative strength of the stock was very strong. It was above 60. It was 81, on this raw value. And we can also see, compared to the market, the relative strength is very high. So this was a very good buy, and there was a 40% move. As a swing trader, you're likely to get maybe only 30% of it, but that is great. I hope you've managed to learn something from this lesson. If you enjoy what I'm teaching, check out my other videos. Sign up to the newsletter because I always share these tips so that you do not forget. I also send out stock alerts of stocks that are showing these technical patterns. This is just one aspect of understanding how to make money from the stock market. If you want to learn more, check out this video so that you can see how you can master different base patterns so that you can know when to enter and when to sell so that you can make these profits. May the markets be with you.